There's this rule of the thumb when you think about retirement, especially on a fixed pension. And the rule is basically that, well, financial gravity always wins.
The further you get from your retirement date, the harder it is to keep up. You're fighting inflation with a paycheck that was calculated on a salary from, what, 20, maybe 30 years ago?
That is the standard economic trajectory. Yes,
The purchasing power of a fixed income almost always erodes over time.
exactly. So the person who retired last year, they're usually the ones sitting pretty, their pensions pegged to modern rates.
The person who retired in the 1980s, well, they are usually the one clipping coupons. But today we are going to look at a situation that takes that logic and flips it completely upside down.
It's a complete inversion of the financial hierarchy.
Retirees who left the workforce almost 40 years ago are currently out earning colleagues who retired decades after them. We're talking specifically about the cohort the Supreme Court on February 5 described as Group 1, pensioners who retired on 1st January 1986 to 31 October 1987.
It's a fascinating case study in how regulatory inconsistency can create unintended winners and losers where there should be parity.
And just to establish the credibility here, because the numbers we're about to discuss, they almost sound like errors. This deep dive is based on very fresh data.
We're looking at stacks of analysis that was triggered by instructions from the Supreme Court of India, and these came down just a few days ago on February 5th, 2026.
That is literally 7 days ago.
Correct. So we're combining that legal context with the Bank Employees Pension Regulations of 1995, the ninth Bipartite Settlement, and crucially, actual pension pay stub data. This isn't hearsay.
This is hard arithmetic, but first we need to identify the characters in this story. Who exactly is Group 1?
Group 1 refers to bank officers who retired within a very specific narrow window, January 1st, 1986 to October 31st, 1987.
That is a tiny window, that's less than 2 years.
It is. So these are people who are likely in their late 80s or even 90s today. They're the oldest living PSB pensioners.
To understand what makes this specific group special, we have to travel back to April 27, 2010. That was the date of the ninth Bipartite Settlement.
Now, typically these settlements are about adjusting wages for current employees, but ninth bipartite, it contained a clause 7 that did something completely unprecedented for this group 1.
The regulator approved a pension updation. Now, usually when we talk about pension increases, we're talking about dearness relief or a cost of living adjustment. But this was different. Updation was an ULIFI of the pension base itself.
Right. So if my basic pension was, say, 5,000 rupees in 1987, it's still 5,000 rupees in 2010, but I just get a bunch of extra allowance on top of it.
Updation? That sounds like something a technician does to my laptop. But in pension terms, it is the holy grail, isn't it?
It absolutely is. What happened was a merger of dearness allowance. They took the consumer price index at 1,016 points, which was the index level at a specific moment in time, and they merged that allowance directly into the basic pension.
So they took the frosting and baked it into the cake.
That's a perfect analogy, and this was implemented with effect from May 1st, 2010.
So instead of having a small base and this large floating allowance, they suddenly had a massive base.
And just to be clear for everyone listening, how rare is this?
It's unique. It has never happened before in the 38-year history of the bank pension scheme, and crucially for the conflict we're about to discuss, it hasn't happened since.
If you like this podcast, please share and subscribe.
Subscribing to our channel and sharing our podcasts on Facebook helps us make more podcasts.
Playing devil's advocate, I suspect this is why the Supreme Court singled out the Group 1 cohort in its chart request. The court clearly did its homework and it might have set a quiet trap for the banks, although I may be getting ahead of myself.
But we need to make this tangible. I mean, merger at 1,616 points sounds very abstract. Let's look at the numbers. We've got a case study here of a benchmark officer.
Right. So to see the mechanics, we're tracking a scale 3 officer. So you can imagine a senior manager who retired on October 31st, 1987, after 33 years of service. He's at the very top of his pay scale for that era.
Okay, so set the scene. It's Halloween 1987. He walks out of the bank in Mumbai for the last time. What does his pension check look like?
In 1987, his original basic pension was fixed at 4,710 rupees or 50% of his final salary.
And at that moment, with zero dearness relief applied yet, His total monthly take-home pension was exactly that, 4,710 rupees.
4,700, I mean, even for 87, that's a middle class income, but it's not exactly a fortune.
Not at all. Now let's fast forward to April 2009. He's been retired for over 20 years. Inflation has done its thing. He's accumulated a lot of dearness relief.
Exactly. By April 2009, that 4,710 rupee base had grown to a total monthly check of about 41,870 rupees.
Okay, so that's roughly a 10 times increase in nominal terms over 22 years. That seems, well, normal, right? That just keeping the lights on.
It is its standard inflation protection.
But then May 2010 hits and updation kicked in, courtesy of the ninth bipartite. This is the moment Clause 7 activates.
So remember his basic pension, that core number, it was stuck at 4,710 for decades.
Then, boom, in May 2010, because of updation, his basic pension was revised upwards to 11,290 rupees, more than double.
Moreover, regulatory compounding kicks in. Because the basic pension doubled, the dearness relief calculated on top of it also exploded.
So, in one single month, his total pension went from 41,000 said then ma'am some and then that is at 70 rupees to 65,200 rupees, a 50% increase overnight.
Thereafter, every single subsequent inflation adjustment over the next decade just compounded that growth.
By 2020, that same officer was receiving 138,400 rupees per month.
But the raw number is only half the story.
The really shocking part, and this is why the Supreme Court is looking at this now, is the comparison. It's not just that these retirees are doing well, it's that they are doing significantly better than the people who replace them.
You would just assume a person retiring on a 2010 salary, which was obviously much higher than a 1987 salary, you'd think they would have a bigger pension.
This is the part that really blew my mind when I looked at the charts.
You would assume that. Logic dictates that. But the data shows a complete inversion of fortune. Let's look at the monthly pension checks, say, as of late 2024 for 3 different generations.
Okay, so first, our Group 1 retiree, the person who left in 1987. As we noted, they are taking home 135,600 rupees.
Now let's look at someone who retired in 2002.
They are getting 91,450 rupees.
That's a 40,000 rupee gap below Group 1.
It gets worse. Let's look at someone who retired in 2010, the very year this regulation was passed. Their current pension is only 80,700 rupees.
Hold on. So let me get this straight. The person who retired in 1987 is making 55,000 rupees more per month than the person earning a modern salary who retired in 2010.
Correct. Remember, Group 1 retirees were the only cohort that received updation, and it shows.
Well, it comes down to the mechanics to understand the why. It's essentially a double dip advantage that only Group 1 enjoys.
Dip number 1 is the base pension updation we just talked about. They got their base modernized in 2010.
But dip number 2 is perhaps even more powerful. It's the dearness relief slabs.
Slabs? It sounds heavy.
Well, think of them as the formula used to calculate your inflation bonus, the formula that's used for retirees from before November 1987 is currently the most generous in the entire industry. It provides what's called 100% neutralization.
It means that if the cost of living goes up by 100 rupees, your pension goes up by 100 rupees, you are fully shielded.
Okay, that sounds fair. Isn't everyone shielded like that?
No. And that's the key. The retirees from 2002 and 2010 are on what's called a tapered formula. As their basic pay goes up, the percentage of inflation relief they get goes down. It creates a curve that flattens out.
I see. So the modern retirees have a kind of ceiling on their inflation protection, but the 1987 group have an uncapped elevator going straight up.
Yes, Group 1 enjoys a boosted base pension and the strongest inflation protection. But 2002 and 2010 retirees never received a base pension updation, leaving them stuck with their original pension, and their inflation formula is weaker.
It's like one group is earning simple interest and group 1 is earning compound interest on steroids.
That's why we call it the pension paradox. Group 1 old pensioners are the highest paid. It just reverses every single assumption we have about the financial life cycle.
But, and there's always a but in these stories, not everyone got invited to the party. We mentioned earlier that this cutoff date, October 31st, 1987, is a hard line in the sand.
What happened to the person who retired on November 1st, 1987, the very next day?
That's group 2. They're really the tragic side of the story. This is the group suffering grave injustice.
We're talking about retirees from November 1st, 1987, all the way up to March 31st, 1998. This is the Group 2 cohort.
Essentially, yes, they were hit with a double whammy. First, they did not get the 2010 updation. They were completely excluded from that.
So, no base jump for them. But secondly, because they retired after November 1st, 1987, they lost the generous pre-7 slab formula. They got bumped onto the tapered system.
That is brutal. So they missed the updation because they were too young, but they missed the good inflation formula because they were too old.
Exactly. They are stuck in a kind of bureaucratic limbo.
And to add insult to injury, because they retired before April 1998, they also missed out on benefits from a different regulation, the 2003 Gazette notification.
They're trapped. Their basic pension is frozen at those 1987 998 levels, which are incredibly low by modern standards.
That's heartbreaking. It really highlights how arbitrary these dates can feel. You're born a month too late, or you decide to work one more month before retiring, and boom, it changes your financial reality for the next 30 years.
It raises a very important question about the design of pension schemes and their real life impact when they're suboptimal.
Right. In 2010, Group 1 retirees probably look like a charity case. Let's help these seniors out.
Exactly. They probably just underestimated the long term impact of the index points and those specific DA slabs over another 15 years. They fixed a short term problem but created a long term hierarchy inversion.
It's a fascinating bit of history. We usually focus on how systems fail people, like that lost generation we mentioned. But it's rare to see a system accidentally succeed so massively for one specific group.
And that's what makes this analysis so important and why the Supreme Court's involvement next week is so significant. It forces the system to look in the mirror.
So let's zoom out. What does this all mean for you, the listener? I mean, unless you happen to be a retired Indian banker from 1986, in which case dinner is on you. Why should you care?
Well, the broader lesson here is about the arbitrary nature of the PSB pension scheme. It's actuarially unfair and constitutionally disputable. Updation plus 100%. DA for all retirees, irrespective of retirement date, is the only fair solution.
And things like index points, merger of allowances, and neutralization slabs, these aren't just jargon.
They're the actual levers that determine whether you retire comfortably or, well, luxuriously.
Picture this scenario. Imagine meeting your old boss at a reunion. Hey, remember me? I took over your job in 1987. I worked for 20 more years than you, and you're making double my pension. That's a tough conversation.
It certainly would be an awkward dinner party, but it stands as a testament to the power of that 2010 updation, a solitary regulatory update that completely rewrote the financial destiny of a few thousand bank retirees and their families.
Pensions aren't just money, they're formulas, and those formulas can behave unpredictably when stretched across 3 or 4 decades.
It also highlights the importance of keeping up with these regulatory updates. If the Supreme Court instructions from just a week ago are prompting this analysis, it implies that PSB pension landscape might be about to change again.
Potentially, the system is dynamic. Just because you fell into a gap in 1998 doesn't mean a court ruling in 2026 can't try to fix it, but you have to know the numbers to make the case.
Well, there you have it, the pension paradox, where the oldest are the wealthiest and the people in the middle are stuck holding the bag. It's a story of luck, timing, and a really, really good lawyer, or at least a really benevolent regulator.
Indeed, it forces us to ask if a single one time adjustment can invert the financial hierarchy of an entire industry's workforce. In India, what other anomalies are hiding in the fine print of pension funds globally?
That is a terrifying and exciting thought to leave you with. Go check your 401k policies, folks. Read the footnotes. You never know what you might find.
The devil and the fortune is always in the details.
Thanks for diving in with us today. Our next podcast in the series, The Chart for Group 2, will stream this coming Friday or Saturday.